Welcome back to the Investing Markets and Money podcast. Today we're talking about ETFs and we are discussing specifically the commodities ETF market. Joining us is Jigna Gibb, who is head of Commodities and Crypto Index Products at Bloomberg. It's the first time we've had someone from Bloomberg on the podcast. Welcome, Jigna.
Hi, Stuart. Thanks for having me on.
Great to get someone who's, I guess, a little bit more impartial because you guys don't have your own range of ETF products yourselves. But it would be nice to just get a steer on what Bloomberg does do in this space as far as indexes are concerned, because most people will know you as a news or data service or maybe as a TV channel, but don't know what else you're doing in this area.
Yeah, that's a really good point. So Bloomberg is a very well established name in the financial community. Many people know us from our terminals, but within Bloomberg we have a group which is called Bloomberg Index Services Limited, and we are responsible for creating solutions across asset classes composed of indices. Across the BISL team, we have multiple functions. I'm part of the product management and development team, but we're supported by research. We have a good number of engineers, a team in production operations. And what our objective is to create indices that can adhere to two objectives for the ETF community. One is to create a benchmark. So if you've got a representation of a sector or a market, then it can aim to be designed to achieve that objective function. Or it could be along the lines of targeting a theme. And so looking more broadly at ideas like a European defence strategy, or thinking more broadly of transition metals in relation to commodities, they can be the solutions and indices that we would create for the ETF audience.
And most people, if they already own ETFs, they will have something like an index tracker, FTSE 100 index tracker, S&P 500 index tracker. Less familiar with the idea of commodities ETFs. Can you give us some background on how commodities ETFs have come into the market and have grown up?
Yeah, I think it's important to start with thinking about how commodities fit more broadly in a portfolio. And they're generally targeting two objectives. One is portfolio diversification and thinking about when you have scenarios like bonds and equities both underperforming, as we would have seen not so long ago, and also throughout 2022. Commodities are a key performer in that regime, in that market environment. The second pillar is inflationary and to protect against high inflation regimes. Now, commodities being such a large part of an inflationary metric tend to have that effect of mitigating inflationary scenarios. And we've seen that playing out today, right? As we see the environments where we are seeing a lot more demand side pressures and a lot more higher prices in underliers, commodities have been a big beneficiary of that. The second angle that is a sub-pillar, if you will, of inflation is geopolitics, right? And the fact that we're seeing these geopolitical events bubbling on that will have a knock-on effect of higher inflation. To be long commodities, we've actually seen a lot of positive price movement in gold and oil with the most recent events that are taking place in the Middle East. So that's usually how one thinks about commodities. Now, the ETF wrapper is a gateway of access. Whether you're looking at equities, fixed income, credit, whatever asset class, commodities, the ETF access is a well-established way of gaining exposure. So commodities is a strand of how to then get that direct exposure, whether it be to target this strategic long-only allocation, but also we're seeing commodity ETFs used broadly for tactical asset allocation. And that comes when you see short-term price moves and investors seeking to capture those trends and be a little bit more reactive to market events. A lot of that might be taking place, for example, in gold or natural gas year to date. So that's where we generally have been seeing a lot more of the active volume trading going on.
So effectively, people can buy an ETF that's tracking the price of gold or of oil. I mean, gold is obviously one of the more popular trades at the moment, and people who've held gold ETFs like myself over the last few months have done very well out of it. But it is, I guess, it's something for people to realize that this is not something just for the pros. This is actually private investors can benefit from gaining that commodities exposure by buying an ETF effectively.
Absolutely. Yeah. I think the way to think about it is what are your choices when it comes to investment? If, let's take gold, for example, you can go out and buy the physical metal itself and buy the bullion, hold it in your own inventory, but you would then probably want to store it somewhere safe, insure it, and therefore you would be paying an ongoing cost of holding that gold. Now, gold itself has a price feature to it, but it doesn't give you a dividend. It doesn't pay you interest in holding gold. So against that, rather than you receiving an ongoing carry of return, you're actually paying to hold your gold. So by investing in ETFs, you're mitigating some of the operational aspect of going long the physical. And also with the evolution of products, we're seeing a lot more of a competitive landscape when it comes to the fee structures within these products, so that when you are thinking about targeting just that price action, you can do it in a very efficient manner with the use of the ETF wrappers.
And in terms of the actual growth of the market, I mean, who has been trading commodity ETFs? I know a lot of, I call them professional investors that use the futures markets, for example. But where's the growth come from in terms of the ETF market?
Yeah, it comes from, it really has been a range of investors. So as we've highlighted, there's the rationale as to why one invests, whether it be strategic or tactical, and then how and why you're investing, what's the profile of those clients. So traditionally, the strategic long only community have tended to be the institutional investors, those that are thinking about buying the outer allocation for the long run and knowing that in order to benefit from these shock events that we've been experiencing when at the onset of a war or unexpected market events, that you really need to be in the investment in commodities in order to benefit from some of that upside. So you tend to see an institutional community segment taking long allocations to broad-based benchmarks like the BCOM, the Bloomberg Commodities Index, and holding that exposure either through swaps but also through ETFs. At the other end of the spectrum, you'll have more of the asset management and the private banking segment of the community that will also be thinking broadly about, well, if I'm holding certain assets in my asset allocation composition, where would I target an inflation hedging mix? Is it with the allocation to gold? And if so, how do I position gold? Or being a bit more tactical and saying, actually, gold has had this phenomenal run and has pierced 3,500 this year. If gold is potentially at a peak, what next? And so thinking about silver or diversifying from gold into a broad-based exposure of commodities is another play that we've seen the more tactical community taking advantage. So year to date, really, precious metals have been leading the charge, up 25%, but not too far behind. The second biggest rally has come actually from the livestock sector when we look at the BCOM sectors. The way that one can capture that sort of cyclicality of price action across the different sectors is by having a broad exposure. And that's why we are seeing more adaptation of the BCOM and broad-based benchmarks through the ETFs.
And would you say that if you take the average private investor, a lot of them are actually um, unaware of the opportunity set that exists here? Because we've talked about gold and oil get a lot of publicity, but as you've just mentioned, livestock, not a lot of the financial press, mainstream national newspapers, are talking about the bull market in livestock. So, do you think that's an opportunity that active investors are missing out on, but could access with ETFs?
Exactly. It is a way of diversify your diversifier. Right. So if you're looking at commodities as a diversifier to bonds and equities, why just stick with gold, right? That's one asset that's going to be very targeted to the profile of a safe haven. Whereas a broad-based basket that you can access via an ETF to the BCOM index is broadly represented across different sectors, including energy, industrial metals, precious metals, agriculture and livestock, gives a more broader exposure to different dynamics that are playing out. The thing about commodity markets is that each of those 6 sectors that we have within the BCOM have quite different profiles as well, and different characteristics that will be supporting the price action at different times. And so, like I say, diversify your diversifier with the broad-based BCOM index, and use an ETF as a way of access is a way to do that.
I just wanted to ask you that it's a bit more inside baseball in a way, but I've been covering ETFs for quite a long time. One of the issues that used to spring up was the difference in the performance of ETFs that were using the underlying futures market for their exposure to commodities, where the manager's just using futures, versus the advantages of a manager who's actually using, in some cases, the actual physical commodity. So you see this, for example, in gold, where some ETFs are using gold futures and others are actually selling themselves, saying, if you buy us, we've actually got the physical gold in vaults, and you're actually buying the physical metal there. Is there any appreciable difference or advantage from that these days in commodity ETFs?
I think it comes down to a couple of factors. One is, what are you actually getting? So if you are physically backed, then yes, you have the ability to go and potentially visit a vault with a stamp and a serial number of the bar of gold that is referencing your ETF. But in doing so, as I said, that there is a cost of doing that insurance and storage, which would then be reflected in the price and the performance of the ETF. Relatively, there are gold futures contracts that are traded on various exchanges. For example, we have the CME contract in the BCOM for our gold exposure. And the rolling contracts will give you ongoing exposure to gold prices. However, by rolling those futures contracts, there will be a roll yield return that will be contributing to that index performance as well. And so that then also is contributing to the performance of your ETF's returns. So what I think is important is, when you're looking at and considering the different options available, is to understand what are the types of returns that you'll be getting, but also the costs that are associated with the mechanics of each of the underlyings based on that ETF.
Understood. And from where you're sitting, are you seeing any significant product development trends in the
Yeah,
ETF
yeah.
commodity space?
Yeah, it's a really interesting time, because I feel like we've come out of this era of high inflation. We started the year thinking about big things, reflation coming on the agenda, but really it has been a lot more centered around what's been happening in the geopolitical side, the impact of the Trump and tariffs and so on. And I think there's been a viewpoint of look forward of what could impact the markets in the future. So we are seeing a number of distinct themes evolving and being reflected in ETF launches. So earlier this year, we launched a Bloomberg Global Transition Metals Index, which is looking at battery, industrial, and precious metals. It is targeting the exposure of net zero economy, thinking about the metals that would be relevant in such an environment. What we do have alongside that is, within Bloomberg, our Bloomberg New Energy Finance research team, and they put out publications that then allows us to use that universe of commodities that they put in there that are in scope in the index. But the hurdles also remain in terms of an index design and construction, which is hedgeability. So in order to trade the more illiquid components of lithium, cobalt, we cap their exposure at 1% within the index. This has been something that has been an evolving market, as we've seen with liquidity picking up in the underlying futures contracts. But alongside that, it's a theme that's continued to take pace, not just here in Europe, but also globally. And so this is a concept that we see applied more broadly, but also being offered within a thematic segment of our product suite on terms of index development. To add to that, we are also complementing what we have in the existing Bloomberg Commodities universe with a broader set of commodities. So we call this the BCOM Global, and that so we are adding single components across non-US denominated contracts, which we would then be able to create baskets to also play more broader themes, particularly looking at topics like crude oil and the grains. I think that's going to be an area where we'll see a lot of interest for the application there.
And you're talking quite a bit about the BCOM indexes that you guys design, manage, I presume license out to fund managers as well. If somebody is interested in those or is wanting to either create a product based on one of those or wants to invest using those, what can they do?
Get in touch, do contact us. One of my friendly sales colleagues would be more than happy to help. We have a lot of information that's on the terminal, but also on our website, bloombergindices.co.com. And so that has a lot of resources, but we, like you say, are in the business of creating and licensing our indices. So we license the index for reference in ETFs and for benchmarking purposes. In addition, Bloomberg has a large set of data and research. We then can complement that with a data license where we can provide index constituent composition level information for replication, but also to look through what the index composition looks like.
And I was at your ETF seminar yesterday in the Bloomberg office in London, and one of the discussion points that came up, which I thought was very interesting, was the use of leveraged ETFs, which is something I think US investors are more used to than UK investors. Um, can you talk a little bit about what ETFs are? And also, I mean, part of my background is in CFDs, where traders will typically take on a lot of leverage on commodities markets. Do you think those products fit in between just pure long only unleveraged trades and the more higher risk CFD trades?
So I'll start off by saying know your risk appetite with any of these investments. Understand what it is that you're going into, understand the product, know what you're willing to risk in investing in this product, know what your expected return would be. So leverage ETFs have really evolved and expanded. I first started looking at ETFs back in the late 2020s, and I remember when we were talking about leverage products, by design, a structure as myself, we were thinking, hang on, will the investors know what they're doing? They're resetting their exposure every day. There's a path dependency of the exposure they're taking, or do they believe they're buying a linear exposure? So we were really questioning when I was working in this area, as in what it is that we were offering as a product. And the feedback that we got from our sales team was actually this is what the investment community wants, right? So the audience that was started initially looking at leverage ETFs were more akin to the day traders. So Stuart, like you say, familiar with CFDs, knowing what they were taking on in terms of single commodity contract exposures. That is not necessarily the vehicle that every type of investor necessarily needs to go into, because again, understand what your objective is, what you're aiming for, but know your risk as well. So when it comes to leverage ETFs, there is a leverage factor, whether it be leverage to the upside or leverage to the downside. So that leverage is reset daily. So in effect, what you're doing is, like I say, compounding your exposure potentially over time, just because of the nature of the resetting function. And so that should be a concept that any investor that's considering leveraged ETFs should be somewhat familiar with and understand that different scenarios and test those different scenarios in terms of payout versus the underlying for those types of products.
Understood. And would you say that the resetting feature actually helps to reduce the risk if you're trading a leveraged ETF?
Well, if you're trading intraday, then you know what you know what your leverage is for that given day, right? Because effectively you're taking on the exposure from open to close. But it should be something that, as an investor, you're familiar with, knowing that your price exposure will be tied to the performance day to day, not anchored from your entry point to exit point.
And something else you mentioned there, which is very interesting as well, is the fact that you can actually take effectively a short position on commodities prices as well, which a lot of people frequently don't appreciate is a whole new opportunity set on the short side.
Yeah, and this is the cool thing about talking about commodity ETFs. I feel like, it's been one of the first innovators in the exchange traded space, because back in the late 2000s, there was a bubble of activity, a hive of interest in commodities, and which was the next one to take flight. It was almost this phenomenon that we see now reflected in the digital assets community, but really in which was the next metal. I remember, there was a lot of trading of single metals from a number of my colleagues back in 2005, 2006. And alongside that came, with the interest, evolution of product, right? And so, this is where we have seen the advent of leverage and inverse ETF. So we see more of the, as I say, tactical plays using these tools, these ETFs, as a way of expressing maybe shorter term views. So whether it be particularly on a single commodity, and I think they're more frequently applied on the single commodities, you'll see them more of the thematics play coming into the use cases. And you're right, I come back to the fact that commodities have different sectors, they have different underlying market drivers. If we look at performances last year, over 2024, precious metals were up north of 20%, but we had the ags down double digits. So if you held the BCOM, you would have been roughly flat. But if you'd been long precious and short the ags, you could have been up double digits in terms of equal notional exposure. And so it's also understanding, your fundamental views and how to express them in a long and short capacity.
Great. And before we finish, I know it's actually not about commodity ETFs, but it was discussed yesterday at your event and is creating increasing excitement, and that's the crypto ETF space. I know this is an area you look at as well. As we speak, certainly the UK and US regulators seem to be moving in the direction of liberalizing the regime again for these. What's your view on crypto ETFs, and do you think they will eventually provide an avenue for a lot of smaller investors who don't want to get a crypto wallet to get exposure to that kind of market?
Well, what I will say about crypto and digital asset indices is there's been a seismic shift in that market really over the last 18 months. And it really started last year with the SEC approving Bitcoin in January, Ethereum in May, the voting in of a very pro crypto administration for the US in November. And then further to that, year to date in 2025, we've seen a real stability, if you will, where Bitcoin's landed. Now, that's not necessarily been reflected in all digital assets. Ethereum's had its own trajectory, but Bitcoin at least has had a fair amount of, or might I say, stability and Bitcoin in the same sentence. For an asset that's got volatility of 50 long term, that is quite an anomaly. No, but what I mean by that is that the asset class has matured and has been developing. It's also gained a lot of traction. I'm looking at the inflows. We're north of 50 billion of inflows into one of the largest Bitcoin ETFs. So there has been a wider adaptation. And as you rightly say, the the viewpoint from the various regulators, not just in the US, but also the UK adapting a central bank digital currency, MiCA having a more direct exposure for the European community, the Federal Reserve talking about taking allocations to tokens, has somewhat legitimized the digital asset investment community. And that's also then what we've seen reflected in the flows, right? We've seen this seismic events taking place, and we've seen the assets flowing in alongside that. I will caveat that by saying, while the asset flows might be north of 150 billion in digital assets ETFs, and I can see that from one of the functions that we have on the terminal ETF Go with the spot crypto view, you see that some of the market participants are somewhat fickle. So the fact that we've seen outflows of 500 million in a single day gives you a little insight into the types of investors that are taking these allocations. And they're not necessarily the long-term investors that are sticking in. There is something of a more dynamic buy-sell mindset, which could be why investors are looking, because crypto does have the propensity of being very momentum-driven. But to make a more wider adaptation, it would really be interesting to see the institutional community take strategic long-only holdings in digital asset ETFs. What I'll conclude by saying is I wrote a paper recently looking at the ETF flows on digital assets, and I concluded by actually showing that the relative weightings per asset class, and digital assets held something around 1% of total ETF AUM, and gold was at 3%. So, it's fast catching up. If you look at the ratio, and this is something I draw upon quite frequently, the ratio of gold ETF AUM versus digital assets, it's something around 50%. So there's been a fast acceleration of investing via ETFs. And again, it gives access, like you say, it takes away the operational burden going and opening a wallet, interfacing with another app on your phone. You can go to your existing brokerage arrangement to access the ETFs and hold them within the same portfolio that you do your bonds, equities, commodities, and so on.
Oh, fantastic. Thank you for that, Jigna. That's been really informative. And thank you very much indeed for joining us this morning to talk a little bit more about what's going on with the ETF market. And just to summarize, someone's interested in finding out more about your indexes and the research that you're doing, and they don't have a Bloomberg terminal, where can they go to get more information?
Absolutely. Well, it's been a pleasure to be on, so thanks for having me, and feel free to contact me. I'm available on LinkedIn. You can search for me, Jigna Gibb, and you'll find most of the information of what we've discussed on the BloombergIndices.com website as well.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.